Powell spoke and the market flipped. Just when we thought we were out of the woods, and a single line from Jerome Powell shook today's markets. We were expecting another rate cut for December, and then he said, "It's not guaranteed." And just like that, investor confidence cracked. Prices move later, but sentiment moves instantly. And we went down for another roller coaster. Indexes lost strength, and Bitcoin lost its momentum. However, what really matters isn't the news itself, but the breaking of what people thought was certain. Most traders search for reasons after the drop, but in reality, it's often one short sentence that flips the direction. And in times like this, emotion won't help. You need a scenario-based plan. By the way, on Trading 101, I have outlined key structural checkpoints to manage volatility. So check the pinned comment or description if you want to learn more. Today's drop isn't just a pullback, it's the moment the market recalibrates its odds. And in the next chapter, we will see how this small crack could lead to bigger shifts ahead. In the short term, the one event that could flip sentiment again is the Trump-Xi summit. Trade tensions and tariffs remain a sensitive topic, and depending on the tone of their comments, risk appetite could swing sharply. A positive message could bring a quick rebound in sentiment, but a negative tone could trigger another pullback like today. The key thing about such events is that expectations and uncertainty get priced in before the outcome. Markets don't wait for the agreement. They react first to how right investors feel they are. So, in these moments, it's not just about the headlines, it's about reading the tone. Short-term volatility almost always begins with that subtle shift. Despite the weakness across the board, two areas stood out: ETF inflows and AI-related stocks. The fact that capital is still staying in these sectors means risk appetite isn't gone yet. For example, Solana held strong as institutional money kept flowing in, while Nvidia and AMD absorbed selling pressure through strong earnings momentum. This pattern often appears when what matters isn't where money exits, but where it stays. Because the sectors that retain liquidity often become the next trend leaders. So, for now, it's less about the index direction and more about following where money chooses to stay. Those steady flows often end up shaping the next big move. Traditional finance is tightening its stance on digital assets, especially stablecoins. And the reason is simple. Once deposits start flowing out, banks lose the ability to lend and invest as before. Some stablecoins now offer higher yields than traditional savings accounts, so depositors have fewer reasons to keep their money in banks. If this continues, the deposit-based structure of traditional finance comes under pressure. That's why we are seeing growing regulatory warnings and attempts to slow that outflow. And those warnings should not be ignored. They are often early signals of structural change. The same pattern is becoming clearer. Traditional banks feel the strain. Once deposits leave, the old system can't operate as it used to. And since many stablecoins pay higher returns just for holding, people no longer see a reason to lock their money inside banks. As this trend grows, deposit-based finance naturally feels the pressure. The fact that these topics are now openly discussed inside major institutions shows just how fast the direction of money is changing. Moody's recently warned that the growing use of crypto in developing nations could reshape monetary policy. When confidence in local currencies fades, people turn to digital assets and stablecoins for stability. If that trend accelerates, central banks lose the tools they have relied on: interest rates and money supply control. That also affects taxation, foreign exchange management, and trade regulation, the core levers of state power. For decades, money itself has been a form of national authority. But that authority is now being decentralized. Crypto adoption is growing at record speed. Analysts expect over 1 billion users within a few years. When that happens, digital assets won't just be investments, they will become everyday financial tools. At that point, central bank decisions or single nation policies will matter far less to individuals. As alternate systems multiply, people will move capital faster, and borders will matter less for financial control. The current market volatility is simply part of that transition. Structural change always begins with a little chaos. In the final chapter, we will talk about the mindset and strategy needed to navigate it. The confusion we are seeing now isn't just price noise. It is a friction from a system being rewritten. During transitions like this, emotional reactions don't work. Structured scenarios do. Instead of chasing short-term headlines, focus on where liquidity stays, where incentives grow, and where a policy starts losing influence. Because in times of uncertainty, the gap between the prepared and the unprepared widens faster than ever. At Trading 101, I have outlined these transition frameworks in detail. Check the pinned comments or description if you'd like to review them later. The market is quietly shifting toward a new order, and we are standing right at the start of that transformation. Thank you for today, and I will see you next time.